All right. So I'm also recording here. So something that you want to achieve, like add the amount to it, add the date that you think, or the period, the time frame in which you want to achieve that. Is anyone willing to share that with us? If not, don't worry, we'll come back to it at the end of the session. Now, in investing, there's one key word that we always need to understand, and this is something that's popped up on a number of occasions, which is your risk and then your return. And in pure or in simple words, we know that once you're investing, risk and return are very, very inseparable. They go hand in hand. Every investment carries some form of risk, and the question here is that it shouldn't be how do I avoid the risk. The question should actually be how much risk am I willing to accept, and how much risk can I be adequately compensated for. Those are the right questions that you should be asking with every investment option that you are considering. For the time being, I'm just going to mention some few risks that you will face in your investment journey and what they mean, and possibly talk about how we can address, or how we can adequately measure or accept those risks and also get compensated for those risks. The first and the most simplest form is, hi Delali, you can ask your question. Hello, your hand is up. All right, I mean, once he figures it out, we can continue. So the first one is the market risk, which is, this risk measures the value of your investments going up or down with respect to the market. And the simplest form is, if the stock market, the price on the stock market is going down, and you ask yourself, why is it going down? Oh, it's going down because the general economy is not doing well. These are risks that, I mean, you almost always face in your investment journey, because the economy on itself will go through series of cycles that would affect the performance of some investments in the economy. The second one is your credit or default risk. I mean, those who are exposed, or those who are coming from the finance or economics background, understand these basic risk. And we understand the credit or default risk as the one you are lending money to, either a company or the government, the ability of that party to pay you back your money. And over here, it's not just paying you back your money, but also paying back any charge or any return that you have on the money that you've given to that party. The next one is liquidity risk, and essentially the liquidity risk tells you how easy or how comfortably you can sell, or you can how easily you can sell your investment without experiencing any huge haircut. Do you get it? And we have currency risk, which is if you have investments that are denominated in other currencies other than your local currency, which in our local context is the Ghana cedis. We have inflation risk, which I've already talked about, where you save money, you're saving, you are losing real returns on your money because the rising price level is way above the money that you are saving and the return that you are getting on that money collectively. We have concentration risk, and this is the risk of you putting all your money into one thing. Why? Because when that thing goes bust, you should understand that you are losing all your money. And we have risk, which is very, very prevalent in our local context. A lot of investment schemes here are scam, and those schemes are essentially wiping away people's life savings. Now, there's some misconception in terms of risk and return that I want us to clarify, which is, and I think the most recent, the DDEP has helped us understand these terms very well. The first one is the treasury bills are risk-free rates, or the government securities are risk-free rate or risk-free investments. What happened during the 2022-2023 cycle actually gave us a very informed application, which is sovereign defaults can be low, but it doesn't mean it is zero. Which means when you invest in any government security, you can lose your money. The risk is just low. It doesn't mean there is no risk at all. And some people also say, oh, crypto is an investment. Yes, I don't dispute the fact that crypto is an investment. But if you are new to crypto, you may be speculating because of the extreme volatility on the market, especially it's having kind of sandbox regulation in our local context. So if you are new to crypto, I would advise you learn more, or you do your due diligence well before you invest. If you don't do, you might end up speculating and losing your money as to you actually investing in crypto. And other people make some comment like, my friend made, let's say, 2x in 3 months, so I can also do it. And this is a typical behavioral finance term called survivorship bias, where you only hear about the good side, the winners. You never hear about those who lose, or the losses on the markets. Do you get it? These are misconceptions that we most often forget. Once you are hearing people win, we don't know that, oh, they actually lose. It's just one or the other, either a zero-sum game. And one last one, people also say that risk is bad. Please, ideally, risk is never wrong. Risk that is properly managed is how we build wealth. So please, don't understand, or don't go out of any conversation having a conclusion as risk is bad. No, if you're able to manage your risk well, you can make good, decent, and great return on your investments. And there's a very simple test that I ran, which is called the sleep test. And this sleep test essentially is, if you lose your sleep worrying about any investment that you have, then please, you should understand that that investment is too risky for you right now. And with that, you know that your risk tolerance should always match your psychological comforts that you have, and your ability to also absorb the losses when it comes. So if you have any investment, and after investing in it, you cannot sleep properly because you're afraid if it goes down by, let's say, 10%, or even if you lose all your money, you're in a big huge danger. You should understand that, no, this investment is not for you. And especially if you're new to the whole investing space. So the next thing that I want us to look at is time, which is a very important factor in your investment journey. Time, compounding, and essentially your money clock. So compounding, in simple terms, is just the process in which your investment returns. So the return that you make on your investment is able to also make return again over time. So Albert Einstein make a very simple statement about a compounding, saying that the compounding is actually the eighth wonder of the world. Something is very, very interesting. Most people don't pay attention to it, but it's one of the magics in the world that can make a lot of money for you without you even knowing. And with compounding, there's two ingredients, and those ingredients are: one, a decent return. And a decent return here is on an annualized basis or on a consistent basis. Your return is decent, like it's consistent across, amidst the highs and then the lows. When you average it out, yes, the net effect is positive. You are making good return. And the other big ingredient is time. And over here, you should understand this: time is something that you can never get back. Once you lose it, it's over. So a very simple explanation would be, okay, I have 1,000 Ghana cedis. I invest this 1,000 Ghana cedis in an investment security that promises me, let's say, 20% on an annual basis. I mean, this, in the first stage, you understand that, oh, you're going to make like 1,200 Ghana cedis. In the second year, because of the law of compounding, which is the return that you made on your 1,000 cedis, you're also investing that return again. So now the return will not be on your 1,000 Ghana cedis, it's going to be on your 1,200 Ghana cedis. So you realize that there's an extra 40 cedis return that you make on your 200 cedis. And that's how the magic works in terms of compounding. One, your decent with rate of return, and the second one is you having time and patience for the money to grow for you. So you can invest 1,000 cedis, you do nothing. In 20 years time, that money can be worth 40,000 Ghana cedis. And this is the real power of compounding. And with compounding, there's a very simple rule of thumb, which we call the rule of 72. How many of us are familiar with that? You can just give me a thumbs up if you know the rule of 72. Great, Caleb. So the rule of 72 says essentially you want to estimate how long it will take you to double your money when you're investing. And it's very simple. If you pick an investment, you've done your due diligence on that investment, you know that, oh, this investment can at least generate, let's say, 12% for me on an annual basis. Now divide 72 by the 12%. In this case, the 12, absolute 12, don't add the percentage to it. So 72 divided by 12, the answer that you get becomes the number of years it will take your money to double for you. So this is a very simple test that you can run to understand. So you know that, oh, okay, so let's say at 24%, it can take me 3 years to double any investment that I put into that security. And that should tell you how the compounding effects work in reality. And this is something that you can add to your toolkit if you are very new to investing. If you are assessing any investment opportunity, the caveats or the criteria that you'll be using to evaluating all these investment securities, this can be one of it. And I want us to have a very practical example over here. In this case, I'm going to use Ernest Caleb. Ernest and Caleb. So Ernest starts, let's say, investing 300 Ghana cedis every month. Let's say he's now 23 years, and he's investing this money in a fund that generates, let's say, 18% every year. Now Caleb starts investing this same amount, 300 Ghana cedis, but here Caleb started doing this at the age of 33. So Ernest started at the age of 23, but Caleb started at the age of 33. And they will all stop this investment cycle at the age of 53. So in reality, you know that Ernest will spend 30 years investing 300 cedis every month, whilst Caleb will spend just 20 years investing 300 cedis every month. And the shocking truth is that Ernest, spending the 30 years, will make 2.1 million Ghana cedis at this just 18%, whilst Caleb will just make 540,000 Ghana cedis. And you ask yourself, what is happening? With just an extra 10 years, Ernest is able to essentially increase the money by 4x. And this is what we call the money clock. Why? Because as you invest and the money keeps reinvesting, you are able to make more money. And that is why I would say your money can make money for you more than you can work for money. So always make sure you put your money to work for you, so that when it gets to the time that you cannot work for money, your money can work for you. So, and I think the next thing that I want us to look at is the asset classes available in our local context, or let's say the general asset classes in Ghana. So in simple terms, asset class is just a category of investments that have similar characteristics, or investment that have similar behavior. So you knowing these investments helps you to structure your foundational portfolio very well, and also know the kind of investment securities to put your money into, or the options to explore. So the first and the basic form that we know is the treasury bills, and then the government of Ghana securities, and even the corporate bonds. These are issued by either the government or they are issued by the company. and with this one they have tenors, or they have number of years that they exist in the investment cycle. For the commonly known treasury bills, these bills are on the market for either 91 days or 182 days or 364 days. For the bonds, it's more than a year. And these investments now, because of the DDP, we know they are generally considered as having low risk. Doesn't mean there is no risk involved. There is, just that the risk is very low. And now rates on these securities are down, but they used to promise like 18 to let's say 32% on an annual basis. And these ones, they vary depending on the policy rate environment or the interest rate environment in the economy. And the interesting thing is, with the right platform, you can invest as low as 100 cedis in this investment. So it's just about knowing the right platform and being exposed to it, and then you can embark on this, or you can invest in these securities. For the bills and the bonds, you can do that through that primary dealers. They are the ones who submit the orders to the market, or you can do it through your licensed any licensed bank, which in this case is a primary dealer, and or through your fund manager. We also have fixed deposits, and I think it's well known in a local context. That's what most people do. If they have a savings account, the money is into their fixed deposit accounts. And for this, is more specific to the bank that you buy the fixed deposit with. They can promise you some decent return on an annual basis, or the tenor that you are using. But the risk here is that if that bank collapses, there's a higher chance the bank goes with your money. So that's the downside that you need to know. You can also do some mutual funds. So for mutual funds, it's very simple. It's a pool of money for many investors, the likes of institutional, high net worth individuals, and retail investors like you and myself. And we giving the money to a licensed fund manager, or a team of professionals who are good at putting this money to good use for us. So for mutual funds, you have the likes of money market funds. So for the money market, those are the funds that invest in these money market instruments like repurchase agreements, commercial papers. And then we have the fixed income securities, or fixed income funds that invest in the bills, bonds, and the rest. And we have the balance funds. So the balance funds combine both fixed income securities and then the equity side securities. And then we have the funds that are strictly equity funds, where they invest in stocks. And most often, it's not even most often, always, these funds are regulated by the Securities and Exchange Commission of Ghana, and that should be your first reference point in checking whether what that investment vehicle is legit or is legitimate. If it's not recognized by the exchange, I think that's not an investment opportunity you should consider in terms of investing in any mutual fund. And for beginners, this is very, very, very good. It's like an excellent point to start, because whilst you are new to the investment ecosystem, you have professionals who have in-depth understanding as to how they can put your money to good use and also make money for you. So once you give the money to you, these are professionals who are very, very diversified, and they can put the money into securities that they well know how they behave and also generate good return for you. So in terms of the examples of these funds, there are lots. We have the Data Bank M funds, E funds. We have the Blackstar EBF, the CCMF, the FIAP. We have IC Liquidity Fund, and there are more than 50 funds in the country, 50 mutual funds. So you can just go to the SEC website and go and check that out. And with this, you can invest as low as, I know most of them, you can invest as low as 20 Ghana cedis. So there isn't any need to say, oh, I don't have enough money to invest, because these investment securities or these investment options, you can invest as low as 20 Ghana cedis and just top up with time. And the next one I want us to look at is the stock exchange, which has gained traction of late this year. There's been some serious rally on the stock exchange. Why? Because a lot of people are getting to know, and with the current interest rate environment, most investors are shifting away from the fixed income and to the stock exchange that can promise more return. So we know our stock exchange was established way back in 1990, and as of now we have about 36 listed companies, and these companies span across banking, mining, manufacturing, telecom, and the notable ones are the likes of the MTN, the Cowbank, the GCB, the Unilever, and the rest. And with these ones, I mean, you are rest assured, although the risk profile is very very high, you are rest assured, if you chance on a good company, you can make very exceptional return, the likes of 2x 3x in a year. And you can access these stocks through all the stock brokers or any platform that they have. So with IC, I think you can do that with the IC World platform. Those who are familiar can just share a link here for those who don't know to access. And you can also do it to Blackstar app. So I think these are the well known. And there's also Data Bank. But if you really want to check, I'll send a link here to a website that you can check. It takes you through the step-by-step process of investing on the stock exchange. A second. All right, how to buy stocks. Great. Okay, yeah, you can go to this website. It will take you through the step-by-step process of how to buy stocks if you are very very new to it. If you're already into the space but want to know the other platforms that you can use beyond our household names like the IC and the Blackstar, you can also check that out from this website. And for this, the minimum you can invest is 1 share. So if the share price is 10 pesos, you should understand that the minimum you can buy is 10 pesos. So from here, you know and you understand that investing is not reserved for the rich, or it's not reserved for the wealthy. You don't need to make 10,000 or 20,000 Ghana cedis a month before you can invest. With as low as 1 cedi, you can also start investing. And the other form that I recommend, which is if you are well versed, you have good sense of your investment journey, you can consider is the real estate. And in the real estate, you can either do buying physical land or buying physical properties. And with this, you know that you can be rest assured in terms of your rental income or the appreciation of the land. But you have to understand that the risks involved here is that these investments are highly illiquid. It's very very difficult to sell them, and if you are selling to, sometimes you might take some haircut, especially when you don't want to. And with land, sometimes there might be some disputes on the land. So these are things you always have to take into consideration before you do these real estate investments. But the good side is that you can invest in REITs, the real estate investment trust. These are alternatives to buying the real land or buying the real property. And I think the most recent that one I know, someone can give us more context, is the Dragoon IPO, the REIT IPO. That was just recent. You can speak to anyone from IC Securities. They can help you invest in any of these REITs instead of buying the real asset that is capital intensive and also carries quite high risk. You can also do that through Sentinel Asset Management. I think they have a number of REITs instruments that you can also consider. And another important one that I would also add is on your pensions and your provident funds. So for the workers, you know Ghana has 3-tier pension scheme. Your tier 1 and 2, the mandatory ones. Tier 3 is voluntary. It is voluntary, but it's very very advantageous. So I would say if you are working, please take full advantage of it to the brim or to the fullest. Don't see it says you can do up to 16% of the contribution. Why don't you do the full max? Cause one, there's tax savings on it, and two, we're able to invest without touching that money for 10 years and over. You can withdraw that money tax free. And the interesting thing is that if you can check your tier 3 alone, if you invest up to the max or the maximum cap, it's more than the sum of your tier 1 and tier 2 combined. So you should understand that's the only factor that can make you more money. You don't rely on your tier 1 and 2. It's very good, like one of the best investment options to consider with your current employer. They can get the fund to invest, and most often, with my experience, these provident funds do way better than the SNETs and then the tier 2. So I think this is a very good platform you shouldn't joke with. And with more exposure to, you can consider foreign denominated investments like the euro bonds in Ghana, or you can also look at some investments in the US market. If you are new and you still want to be exposed, but you want to have enough sleep, you don't want to experience restless night because the investment that you put your money in, you cannot rest, you can consider some funds from Blackstar. I think that's the enhanced equity beta fund. This fund is exposed to the US market, where you can invest and make decent return. The next thing I want us to consider is diversification and how we think in terms of our portfolio structure. And there's a very well-known old adage, which is you don't put all your eggs in one basket. So if you don't put all your eggs in one basket, then you should have a way of thinking through how you allocate your money to your investment portfolio. And the simple layers I want to recommend here is into 3 forms. We have the safety layer, we have the growth layer, and we have the aspirational layer. So the safety layer, for this, you commit 30 to 40% of your investment income, and with this you can consider the likes of your treasury bills, your money markets, mutual funds, your fixed deposits, kind of the low end risk investment if you don't have high risk appetite. And then for your growth layer, that one you commit about 40 to 50% of your investment income to that, and this considers the likes of balanced funds, investment that invest in or funds, mutual funds that invest in both equity and fixed income. You can also consider only fixed income end of the mutual fund. You can also invest directly on the stock exchange, and with this, you know that it promises very high growth potential, and your risk level is also quite high. And your aspirational layer is where you take higher risk. And I always, like, all the people on this call, I know most of us are not even more than 30 years. So if you are not more than 30 years, you should understand that you can take on more risk than you can imagine, which is, you are young. If you lose some of your money, you have enough time to make that money back. Do you get it? So your aspirational layer is where you commit like 10 to 20% of your investment income, and for this, that is where you consider the high and risky investments, because you need to be exposed to some form of risk to make some higher returns. Do you get it? And that is where you can consider real investment like real estate, whether buying the land or buying the properties. And real estate in its own is very expensive in a local context. I mean, you see the tax around. You need to buy. You are buying a studio apartment for 1 million Ghana cedis, 500,000 Ghana cedis. So if you should be grounded in terms of your capital before you can do this kind of investment. And you can also do some private investment in businesses that you know have solid underlying potential. You can also look at higher risk assets, or investments that has higher risk, but then based on your assessment you believe will give you higher return. And I think I would proceed with a very simple psychological truth about how we behave in terms or how we behave financially. And in this, we call it behavioral finance. And you should understand that the most dangerous thing in investing is not a bad market or economy that's not doing well, or investment that's not doing well. Your dangerous tool is your mind. Why? Because how you behave towards your investment will determine whether you are making rational or irrational decisions. And with this, we have key biases on the market that most people, one way or the other, might end up in. And when you read books like The Psychology of Money, you really understand and appreciate this very well. The first one is FOMO, and I know most of you on the call know FOMO, the fear of missing out. And why do you fear of missing out? Because you just buy into an investment because everyone is buying, the price is going up. This is a very classic head behavior, and with this, most often you end up buying at the time that the price is very, very high. A very typical example is what is happening to MTN. MTN went all the way to 6 cedis, 53 pesos. Now what's the current price? 5 cedis, and there's possibility of the price falling more. So you always have to make sure you do your underlying due diligence well before you enter into any investment. You don't buy because everyone is buying. You should know when to buy. And the next one is loss aversion, where when you lose, let's say you lose 1,000 cedis, you feel so bad about losing that 1,000 Ghana cedis than you even making 2,000 Ghana cedis in return. And this thing happens a lot to people, where the pain of you losing the money is more than the joy that you gain for gaining, let's say, 2 times of that money. And this is something that really happens to most investors or most beginners to the whole investing landscape. And we also have the confirmation bias, where once you've invested in one security, Cowbank, you're only looking for information that supports why you've invested in Cowbank or why you've invested in that security, and you are ignoring all the warning signs that show that, Charlie, this investment is not good, this investment is going bust. You ignore all those things. And we also have the head mentality, where you do what the crowd says. Everyone is buying MTN, so you are buying, and it makes you feel safe. But you should know that once the crowd is in, the value is gone. You are going to buy at a price that's not good, and it will take time for you to make real return on that investment. And sometimes people are also overconfident in what they invest, and this happens most often to beginners, where when they go to the market, they look for companies that the price are very, very low. And the reason is, I think they check something like, let's say MTN started trading at 75 pesos, it's now 5-6. Okay, so if I get another company that's trading at, let's say, 10 pesos, and I buy more shares, maybe in some time to come it will trade like 5 cedis like MTN. So they go all in, and they believe that, Charlie, I don't know what the company is doing now, but it will do well in the future. And this is a very common practical mistake most beginners make, and they are so confident about it. And we have the recency bias, which is you assume that, Charlie, once performance has been good recently, Charlie, it's going to do well coming or in the future. And this recency bias, a very practical form is this. It's like you driving or you sitting in a car, and you are looking at the rear mirror instead of you looking at the windscreen. You are not looking at the big picture, what is ahead, how you should structure your portfolio, how you should think ahead. You are thinking, Charlie, it did 40% three months ago, or last year it did 40%, so this year is going to do 40%, and you are investing in it. I mean, the market doesn't work that way. It's purely out of supply and demand, and what investors believe the performance is, or the current value of that investment is. So you should always be looking at what is ahead, or how the performance will be, not only consider recency or what has happened in the past. Yes, that matter, but don't always be fixated on the past. Make sure you also accommodate some margin of safety or room of error in terms of your investment decision. And I also want us to talk about due diligence. How do you evaluate investments if you are new to this space, or if you're already in it? How do you evaluate your investment? I want to open this up for anyone to answer. Before, for those who said they have investments in stocks, those who said they have investments in some mutual funds, how did you end up buying those ones? Was it that you had a friend who said, these investment securities are good too, buy it and you just purchased, you didn't do any due diligence, or if you did, how did you go about that? So you can unmute yourself and answer if you want to answer this. Yeah, go ahead, Eldan.
Yeah, so I think with me, at some point, I remember, I think late last year, by then CPC was doing well, right? And then some friends of mine were like, oh, CPC is good. I mean, it had risen a bit and all that. So I had a friend, which is Ebenezer Odum. I don't know if you know him. And I contacted him since he was an investment analyst. We just asked for his opinion on CPC because I don't know, it was like the stocks were rising, but I didn't know what exactly was triggering it, what was causing that rise. So after having a discussion with him, I just realized, I mean, even though it was rising, I had to just hold on a bit and all that. So I think, regardless of what I see on the market, I try to consult. I mean, someone. Fortunately, I have friends who are also in the investment landscape, so I just consult with them and then ask for their opinion, and then whatever they tell, I just try to make my decision around whatever advice they give me.
Lovely. So Oda said that for him, before he makes any investment decision, he reaches out to people who are well versed in the space to get their view on whether that investment option is good or is something that is worth the price that the market is paying for. Does anyone want to add on to that, or has a different perspective to evaluating?
Hello.
Yeah, go ahead.
Thank you. So for me, when I started, it was based off what a friend of mine told me. They were like, this particular stock is performing well, or that. I didn't really do any checks. I just invested based on what they told me, and the good thing was that didn't actually come back to bite me. So I'm thankful for that. But as I went on later, gaining knowledge in investments and all that, I began actually analyzing, studying the financial statements of, let's say, the companies that I was trying to invest in, or I was maybe hopeful that their shares or stocks would increase in the long or short term. So I started off based off what somebody told me, but then as I later got into the investment and all that, I realized that I needed to maybe look into the performance of the company in terms of what they are reporting, what's in their financial statements, before I can actually make the decision that this stock is safe to invest in. Yeah.
Thanks, Louise, on that. So Louise said, oh, he was fortunate to have friends who recommended some securities for him, and he didn't go against that. I mean, he made money, but for now, he has opened his eyes. And for any investment, he has to check on his own, do the underlying financial review before he invests. Yes, Carl, if you can go ahead.
So you said we should do due diligence. What are some of the due diligence that we have to do to know that this particular will perform well?
Yes, Caleb, we'll come to that, but I wanted to understand. I mean, from the beginning, I realized that some people have investment, or they've already done some investments. So I wanted to understand, how did they arrive on investing in those investment securities or those investment vehicles? How did they do their diligence? So, Caleb, if you have investments,
for me, I've made some investments, and I have a background in finance. I read about finance, financial ratios, and analyzing the economy using more of the fundamental analysis to analyze your stock. So I bought MTN shares, and I bought it. It was based on someone's advice, though. And when I look at the technical analysis, the prices in the past years or months, it has been performing well. When you look at their revenue is performing very well. Though they spend more of their revenue in most expenses. When you look at their financial statements, they do generate more revenue, but most of their revenue they spend it on operations and that things. All this is based on the financial statements, on the fundamental analysis.
All right, thanks.
MTN is performing well.
Thanks, Caleb, on that. So Caleb was just taking us through, for those with finance or economics background, um, top down or bottom up analysis, where you look at the general economy. For the top down, like what he said, general economy, you scale down to sector, industry, and to the company. If it's from bottom up, you look at the company. The reverse order, scale to the industry, sector, and the entire economy. Yeah, and these are things that are done in real world scenarios in terms of the industries. And I want to add on to what you have said in terms of how you evaluate your investment securities. And it's very interesting how there's a consistent theme across, which is we all had people, we all have some people in our network that before we make any investment decision, we reach out to those who are well versed in it to give their opinion on whether it's a good investment or not. So it's a 7-question list or 7-question checklist that I want us to keep in mind. You can write it down, you can record it, or I can share with you later after this call, which is on your own or before you go to your friend that, oh, I want to do this investment. This is what I've been able to research about that investment opportunity. What do you think about it? Do you get it? And from that sense, you're able to explain to the colleague or the friend that, you know what, I did my homework and I'm quite optimistic or positive about it. But what do you also think about it? The first one is, first you should know who is offering that investment. Is that company? If it's a company, is it listed on the stock exchange? If it's a fund manager, is it licensed by the SEC? Like, these are the basic questions you should ask. The second one is, what exactly are you investing in? Do you actually understand how the business make money? Do you understand how the fund actually make money? These are basic questions you should be able to answer. And I know for sure, in fact, we are all victims of that. There are a number of companies that we, or investment security options that we've considered without we really understanding what the operation of that company or that investment is. The third question I want us to ask is, what is the expected return and how is it generated? How does your investment make money for you? If you're investing in stock, you should know that 2 ways: either the share price goes up or the company pays dividend. That is your realistic way of making money. If you're investing in a mutual fund, you should understand it's purely out of the value of the fund or the fund share price going up. If you are investing in treasury bills, how does it make? Oh, at the end of the period or at maturity, I get my money back, I get return on it. Like, these are the basic things we should understand about it. Okay, with these forms of investment, what are the risks involved? If you are buying shares, what is the risk involved in buying shares? And I know from here we know that for shares, the basic risk is you losing your money. The worst case scenario is you losing your money. If you buy, let's say, treasury bills, what's the worst case? The worst case is the government saying, "Now I cannot pay your money back to you," and even the interest on it. So these are some initial risks you should be able to identify with any investment that you want to put your money into. The next question that you should ask yourself is, how and when can you exit? And it's a very important question, because most often when you are doing investments, because you have a long term mindset, you mostly don't think about when am I going to sell this investment, or when is the right price for me to exit, because you are looking at, oh, I want to hold this investment forever, or until I pass it on to my hair. Do you get it? So these are questions you should be able to ask. And the reason why you should ask this question is when things become, or when things are not as smooth as they are supposed to be, you might end up falling on these investment options. So you should know how easy it is. You should know how easy it is for you to sell that investment and also make your required return without you losing money on that. The next one is you should also read some materials about that investment. And over here, if it's a company, read the company's financials, just like Caleb, Louise, or said. If it's a fund, every fund has prospectus. In fact, all listed companies also have prospectus. You can pick any of those documents, you read them, and understand how these investments were made known to the public. And you should also know what happens to your money if the company fails. Yeah, hi Esther. I'm having a feeling I know what you're about to see. I think I've seen it. I'll be wrapping up very soon. So you should also know that if the worst case happens, what happens to your money? Once you know that you can run the sleep test and pass that test very well and sleep. So I always say that the same way, if you are going to buy a car, you go for the test driving to check whether the engine is working, the registration, car papers, everything is working very fine. Why? Because you are paying, let's say, 20,000, 50,000, 100,000 for the car. That is the same way if you are doing any investment, you should also do your due diligence to be sure whether it's a good investment or it is not. Do you get it? Yeah. And my time is up, so I want to wrap it up. So I think I would end with some goals or some strategies that you can form for yourself, which is one, you should always have a budget, and in your budget make sure, in fact, your investment becomes part of your expenses. It should be taken out before you think about the food that you are going to eat. When you take out your tithe, if you're a Christian, make sure you take out your investment before you think about your expenses, because like I said, your money can work for you more than you can work for money. So you have to always make sure you allocate that money first. And if you have any toxic debt, any debt that is eating up your money, make sure you pay that debt off first before you think of investing. Why? Because if you have debt and you've not paid it off and you're investing, at some point you go and sell your investment to pay off that debt. And if you're not lucky, you might sell off that investment at a price that is not good compared to when you entered. So always make sure you clear any debts or any bad debts that you have on your books. And always, after clearing the debts, make sure you also build emergency fund. If you, let's say you spend 1,000 Ghana cedis on your expenses every month, make sure you're able to save like 3,000 to about 6,000 somewhere, and you fall on that money for any emergency. Because if you don't do that and you go and invest the money, when the difficult time comes, you go and sell that investment to go and meet that difficult time. And sometimes, like I said, you can sell at a price that is not good for you, and that is not the goal of investing, because you want to invest for the long haul and make money over the long haul. And always make sure you stay healthy, so that you whilst you make the money, you can also enjoy the money when it comes. So I think this is what I would like to end with. Thank you all. I had a lot to share, but I think time will not permit me. So thank you all very much for your time. If you have any question, I think I'm available to take those questions for now. And Esther, sorry for the time. Over to you.
Mr. Princess Samuel, thank you very much for today's session. I noticed people were still having on doing it. And I also wish it will not end, but time is not on our side. Yes, I believe if you don't have maybe a direct contact with Mr. Princess Samoa, he can share his contact in the chat box. Yes, but at this point, we'd like to take questions. So please, if you have questions, you can show by hand so I call you. Okay, Edwin.
Thank you very much, Prince, for these insights you shared. So my question is in relation to someone who does not have any finance background and then still wants to invest. I listen on the call, people talking about analyzing financials for someone who is just out of school without any background, say a science student. How do I navigate this part? And I would also be grateful if you could touch on how AI can also help me, someone who does not have a finance background, to still be, investor ready. Thank you very much.
Hi, Edwin. Actually, I wanted to answer your question with AI. Right now, there's a lot of resources in the world. You literally don't need any background knowledge on anything before you can learn about it. You can just pick your phone. Before this call, I was checking my mail and I realized that one of the US stocks the company went public or did IPO recently. It's called Figma, and the price over the week went down about 14%. So I went online to check, and the price has actually gone down for more than 80% from the time it IPO'd. I'm like, oh whoa, this is a good opportunity for me to buy the shares because it went all the way to $140 and it's now $20. So I can buy at least a share. Do you get it? And now, how did I get to know this? It was just simply going through my mail, seeing that message, going online to go and search why the price has fallen, and they give a number of reasons. One, they call it SACS apocalypse kind of market is generally selling off from this AI boom. Investors are no more quite optimistic as they used to be. The companies also investing a lot in AI infrastructure, so because of that they are losing money. Some of the companies investors are cashing out their money after the IPO. I mean, these are things that I could easily get from just going online to search why has Figma share price fallen more than 80%? Do you get it? So if you are new to it, you are very new to the investing landscape, you don't understand anything, you can ask online. You can just go online, ask your AI, your Claude, your Chat GPT, your Perplexity, ask it, oh, MTN Ghana listed on the Ghana Stock Exchange, what does the business do? Just like the question list that I gave, you can ask what does it do, and it will explain to you. Explain it as if you're explaining to your grandparents or to a 5-year-old kid, and it will explain to you. And the good side, the link that I shared earlier, is also a very good platform for you to learn about analyzing financial statements of companies. All that you need to go is just go to mullatechnologies.com. You go to the learn tab. You can read about how to analyze these companies if you are very very new to the space, and also you have some reports of these companies that you can put those those skills that you learn from that platform to use. So yeah, I think in all, just be curious. Once you are curious, you the world is limitless. You can learn a lot in it. Thank you, and I hope this provides more context on your question, Edwin.
Okay, please, any other question? Please, are there more questions?
You guys are not asking questions.
I guess not. All right.
Joseph.
Okay, Joseph, you can ask your question. Hello, Joseph.
Maybe he's struggling to turn it on, but he can leave it in the chat box if he cannot unmute.
Hello.
Yeah, we can hear you, Joseph.
Can you hear me now?
Yes, we can hear you.
Hello.
We can hear you.
All right. Thank you for the opportunity. Okay, so I want to ask, with investment and savings, I can see it's a good thing. Though I'm not a business student and I don't know much about that. It's a good thing, but I don't know the reason why it is not popular in the system. But I can see a lot of people are into it, and it is not popular in the system.
I think it's something that recently a lot of investment houses, even the Ghana Stock Exchange through the Hello, can you hear me?
Yes, please.
All right. So I was saying that it's something that recently a lot of investment houses and individuals within the space have been trying to reach more audience or more people in the country as to the essence of investing and also saving. And we see the likes of the Ghana Stock Exchange through the Young Investors Network, and even this platform, the Emerging Young Corporate Leaders Fellowship, also having a chance to organize these sessions where we speak about the essence of investing and how you can do it. So yes, our local context, most people were not exposed to it, but with time we are getting there where we have quite a number of platforms that you can use to learn, and also individuals who are available to teach us through all these process in terms of if you want to embark on that. And there are also a lot of investment options or investment vehicles that you can use. And yeah, I think it was more of these investment houses did not really pushing out in terms of advertising their products, like the way you go online and then, or let's say you watch TV and you see all these ads. And I don't know, but what's I'm not sure. I'll put it, I'm not sure, but what I know is that I think the investment houses were quite limited as to they advertising investment products like the way we advertise household products or brands. So I think that has been it. But now there's decent awareness on the ground. Once you check online, you see a number of platforms that you can learn from, and a number of vehicles that you can use to do your savings and investments, Joseph. And I hope this provides more context to your question.
Yes, please.
All right, thanks. You're welcome.
Thank you.
Yeah, Francisca, you can go ahead.
Okay, so Prince, thank you very much for the presentation. I really enjoyed it. So I want to ask this question about stocks, the shares that we've been buying. Mm-hmm. If you want to buy shares for a company, right, what are the things that you have to look at, maybe to know that you are investing in a safe company for growth or for dividend or something? So the basic things that you check out before you invest in a company, their shares. So that's
okay. So the basic things first, you look at the company's fund. Hi Joseph, can you unmute yourself? Sorry, can you mute yourself?
Sorry.
So for investing in a stock, I think most of you check the fundamentals, which is over the past 3 years, how has the company been performing? And you look at things like the top line, the revenue, the profit margin. You look at the the balance sheets, the assets, you look at the liabilities, the equity portfolio, you check the cash flow. Is the company making enough cash? Is the company able to meet its cash flow demands? They get so that they have enough cash to run the business. And you look at variables or investments ratios like your return on equity. You look at your earnings per share. You look at your price to earnings ratio, which is how cheap or how expensive the price of the company is with respect to the returns or the money that the company is making. Once you're able to do this basic fundamental analysis and you see the consistent trend that the company is making good money, and most often you also look at the chairman's statement if you are looking at the annual report, because that also gives you some context as to how the company is envisioning the future or the year ahead. Because if the company expects good outcome, the chairman will one way or the other hint that in the annual report, and you can see that in the company's strategic pillar. And another way to assess it is you can pick, let's say, a 5 annual report for the past 5 years. Let's say if you're in 2026, you look for annual report in 2021. Check the growth pillars or the KPIs that the company they set for itself. Now pick most recent and check whether they are tracking or they are way above that. These are signs that show that, oh, if the company has been able to do this, there's a chance they can continue doing that. And once you check the fundamentals, you can now look at the stock performance over the period. So you check how has the company share price has been performing. What is the highest price it has ever reached? What is the lowest price it has ever reached? What is the average price? Do you get it? And that should tell you, if you're looking at the company and the highest price is the current price, you should be quite cautious before you invest in it, because you know that one way or the other you might be entering at an expensive price. If it's at its all-time low, there's a decent chance you have a bargain on investing in the company shares. And once you are done with this fundamental analysis, then you can look at the overall economy, how the company is positioned to perform against the economy. If you have a general sentiment as though there will be a lot of economic activity in the country, definitely consumer goods companies, staple, the manufacturing, these are industries that ideally would do well, and the banking system would also do well, because the comfort level is high, the business confidence is high, consumer confidence is high, so there will be a lot of economic turnover and people will have enough cash to spend. But where we hit levels where the company is not going to do well, the economy is not going to do well, that is where you selectively look at the companies that are at the edge of winning or they are at the edge of making you money regardless of the economic outlook. So in Japan, there's a term called kiki, and kiki is essentially a 2 syllables word. The first key is danger and the second key is opportunity. So for them, when they are assessing risk, they look at risk in 2 forms. What is it dangerous? Are you seeing danger in that risk, or you are seeing an opportunity in that risk? And those are the things you'll be looking out for when you are assessing the overall economy against the particular stock investment that you want to look at. So on a high level, yes, you look at the company's financials, check the share price performance, look at the economy, and then go in if you are quite optimistic about it. Yes, and I hope this provides more context, Francisca.
Yeah. Thank you.
You're welcome.
All right. Thank you very much for your questions. And Mr. Prince, as someone has shared his contact in the chat box, you can kindly save it if you have more questions. All right. I think we'll have to end today's session. Thank you all for joining.
And
I hope you learned it.
Esther, sorry, I want to pass this in terms of the contact. Please, I know we are not going to do that, but please, if you test me, I prefer you go straight to the point, because sorry to say this, but my schedules are very, very tight, so don't come and say hi and expect me to respond before you say what you want to say. please, once you test me high, you go straight to what you are asking, so that once I get the time to look at the messages, I can respond to your question, not keeping you waiting. Thank you.
All right. Thank you very much, Star Samoa, and thank you to all our audience who joined today. And if this is your first time of joining Emerging Young Corporate Leaders Fellowship Masterclass, you are very much welcome. And my name is Esther McAfee, and I've been your moderator for today. If you would like to join any of our WhatsApp platforms, I'll be sharing my contact in the chat box.